Yep.
All right, folks are trickling in. We'll continue to keep an eye on the waiting room, but welcome to today's CFO.
My name is Jonathan Gruchin. I'm a co-founder of the Founder Institute.
Dean, it looks like your audio is on. Now he's gone. All right, here we go. Part 2, CFO Forum, brought to you by EY. My name is Jasmine Hoffman. I'm the head of experience at TechUnited. We are going to be talking about long-term value framework and communication today with some lovely EY experts that are on the line. This forum is, like I said, sponsored by EY, who's been a great partner to TechUnited over the years and just an incredible source of information and guidance. So I am really excited to turn it over without any further ado to Don, who is going to get us kicked off. And thank you for being here.
Thanks, Jasmine, and welcome to all of those able to join us today. EY is proud to host today's session. My name's Don Bucciarelli, as Jasmine mentioned. I'm an assurance partner at EY and a TechUnited advisory board member. Back in October, as part of Propelify, we hosted a session on environmental, social, and governance, or ESG matters, and the expanding importance of ESG initiatives in business. Today, we plan to expand on that and discuss long-term value, which incorporates ESG and focuses on how companies drive value through its financial results, value to its customers, value to its employees, and societal value. I'm joined by my colleague, Maureen Bishara, and we also have with us two professionals out of EY's Financial Accounting Advisory Services group, Neri Buckspin, who is a partner, and Dianora DeMarco, who's a manager, who are going to lead us in this session. We hope that this can really be an open dialogue. We've got the chat feature, and we can bring people on to ask questions, but we welcome those. And with that, I'm going to turn it over to Neri and Dianora.
Thanks, Don. Thanks, Jasmine. And thanks, everyone who joined us today. Just a voice check. Are we coming across well?
Perfect.
Excellent. So, what we'd like to do today is actually a conversation, and it's very well placed because it's not an education session. It's more placing certain thematical underpinning and undercurrents that we have been thinking about at EY for quite some time that are now placed very much front seat for a variety of reasons that we share with you today, but they're quite obvious to many. Interestingly enough, they were not quite obvious when they were started being discussed, 10 or 5 years ago. And it comes to, an interesting confluence of occurrences. And clearly ESG is one of the directions. But what we are trying to do is trying to think about how entities, companies should be and could be thinking about the value that they're driving for a long term in a different way, how they think about the way to approach it from corporate purpose to measurement to behavior to how they think about themselves, how they operate, how they measure, how they compensate, and how they think about things, how they allocate capital, how they accept or reject a project, and equally how people think about them. How people think about them as an investment, how think about them as worthy of credit provision, and how people think about them as a brand or as a future employer. And it all comes together. There's all linkages. And frankly, being an accountant for many, many decades, I would just suggest that the existing accounting measures are doing injustice and in fact, terrible injustice to how those virtues could be appropriately managed and communicated. So that's the virtues of our discussion today. Thanks for having us, and hopefully we'll do a little bit to insight you about how we're thinking about that and engage in a broader dialogue. Dianora, can we just click through? So this kind of puts in context what I've just mentioned. So thinking about ESG is an important one, but the reason that folks...
Is that even good? Or do we need?
The reason that folks have historically thought about ESG and placed ESG together has been thought of more in the context of what's not in current financial reporting. And ESG stands for environmental, societal, and governance. Each one of those virtues is quite separate. Each one of the virtues is quite complex and it has its own underpinning. So painting everything in the context of ESG brush is useful, but it's also useful to dissect it to its elements. The way we think about it, the topic more broadly, is almost looking in the context of kind of what underpins the entire framework. It's the corporate purpose, right? What am I set to do? Who am I? Why do I exist? And why do people think that I exist? Then what underpins it is a strategy, right? The strategy has got to be aligned to it. It's got to be tied to my supply chain, process, data, system, control, management, reporting, and in turn, how do I build trust and confidence in the market that turns into validating, propelling, excelling, driving my purpose. Shareholder value, as people are thinking about it today, is a broader stakeholder value for a company. What it ties to in a more important nexus is there's a whole slew of discussion there, and we'll speak with you a little bit about metrics and measures and an alphabet soup that associated with that. But at the end of the day, if I'm a corporate executive or I'm a corporate board member or I'm an investor, I got to make a decision. I got to allocate capital. Investing in a particular virtue, the results of which may penetrate or pan out over many years, are uncertain. I can make X dollars of investments today in the environment, in various elements of ESG. I can invest X dollars in R&D. I can invest Y dollars in emerging markets. How do I make the decision? How do I allocate capital? How do I think about ROI? How I risk weigh my ROI to make sure that the yield is appropriately adjusted as part of those thinking. And each dimension is tied to each other, because thinking on each dimension in isolation may help you a little bit, but in our view would not be the right approach to thinking about it. And we'll tell you a little bit about how we tie ESG to this entire broader suite of thinking, how it relates, how it correlates, and how it's so important to ensure that companies are maximizing value and not leaving money on the table. We also bucketized it, for the lack of a better term, or clustered it, or used pillars to think about what are the values that the company should be thinking about, what's the value drivers. And by the way, it could be 4, it could be 5. You can slice and dice them in a variety of ways, but when we're starting to think with companies and clients, how are they thinking about it, we like to cluster it by value pillars. That helps you think about it along dimensions and along pillars. And we'll expand on it as we're going through the discussion, but I just wanted to make sure that we frame the conversation in the context of how we think about it, what are the pillars of the house, and how it all holds together, and how it is built to last and prosper. Let's move on to the next slide. Please, Dianora. Thank you. So I mentioned previously the elements of ESG. So I think it's just, every newspaper that you open, every discussion, including with the administration and the SEC chair or incoming chair, Gary Gensler, appointment hearing that was the day before yesterday, the topic of ESG is mentioned. In particular, the topic of climate and equality and diversity. But when you start looking at the components of E, S, and G, they vary, each one of which may signify different level of importance to either different companies, different environments, or different virtues. How to think about that, how to measure that, how to manage that is super important. So what I want to make sure that the notion of ESG is important, because when you're hearing ESG or when you're managing ESG, it's very interesting to be attracted to a single word and think that ESG is one thing. It's definitely not one thing. And if you think about the right side, which is governance, this is an area that companies had for a longer period of time a better elements of reporting associated with that. So how companies are governed, what's in the US context, the proxies, the 10K, there have been greater disclosure around governance. There's a subset here that addresses disclosures and greater demand by investors, regulators, and others to greater disclosure. Will point to that. And those are specifically concentrated in the area of environmental and social, including how they govern, but the area of reporting and emphasis of reporting, in particular in the US markets, refer to dimensions of the left that are, and Yanora will share with you some more information around what's going on in this area, the area of reporting more specifically, but it's important to recognize, and some of you are sitting in a CFO seat or corporate reporting seat or an investor relations seat, and you are clearly seeing a much greater demand for corporate reporting in that area. So it's not only the managerial side, is how do I manage and how do I report and who is asking for this reporting? And we'll share with you some of those virtues, but it's important for us to just lead into the discussion with the recognition that all those undercurrents are just now coming together. Let's move on to the next slide. For those of you who spend time around accounting, you all know that there's gap that existed for and refined over 100 years. In the context of how we measure certain of the dimensions of long-term value creation, needless to say, there's no consensus. There's an alphabet soup of standard setters that are promulgating standards. There are rating agencies that rate people based on how well they do on some dimensions versus another. Needless to say, they all not agreed. It's the same thing that you ask a professor to rank a student in a class, and one will rank the student A, the other will rank the student F on the same performance. And they're all arguing it's the same class. And you'll see credit ratings that are having inconsistent methodology. You're looking at indices that may or may not include particular companies, and some would assert that they're actually accretive to the index purpose. Let's say it's an ESG index, and others will say, no, we actually exclude this company. I'm taking the extreme, which are clearly obvious, but there's some things in the middle. And those are the weights, the balance, and how much companies are attracting capital. We'll talk to you a little bit about this alphabet soup. There's a lot of going on. We are spending a lot of time with regulators and standard setters in trying to introduce some order to this maze to make sure that people are getting some clarity. But the subset for this group that the next, I would suggest, starting today, not today, starting with actually a few months ago, and based on some of the some of the developments that we'll share with you, and probably in the next 2 years going to be quite instructive in the context of how global regulators, US regulators, standard setters, including even private market dimensions that we'll point to, will probably mandate and introduce greater consistency to the entire area of ESG reporting. What you listed here on the right side is only a small sliver of organizations that currently promulgate a variety of standards. And some of them are simple sliver of dimension. For example, TCFD, which is listed here at the bottom left, will only be addressing climate. But there's even a more nuances associated with those, because some of them are looking at reporting that are only for investors, but others are looking at reporting that are dual purpose. There could be for investors, there could be for communities, there could be for regulators and government. So this is framing, this is shaping. The SEC has been on record that they're going to start looking at this very closely. The incoming SEC chair in its confirmation hearing alluded to that. So I would just say, keep your antennas up while you're having your seatbelts on, because that's going to have a pronounced effect on many, many, many areas that we are going to be interacting with. Dinora, let's move to the next slide. And this is the reporting on matters that drive LTV, and in particular ESG. This is looking at some US companies in the S&P 500 and how they report. And what I can tell you that it's consistently increasing. The SEC has introduced a requirement last year that we are seeing it for the first time to report human capital disclosures. We're seeing some companies, while others not yet, that introducing it to the 10K to some extent. But what we are seeing is greater demand for that information by analysts, by investors, by institutional investors. And what comes along with that is a particular interesting role for the CFOs, for those that deal with the street, with the lenders, with the capital providers, because they're being asked. And they're being asked, and sometimes when you ask and you are providing certain information to a capital provider, whether you place it on a page of a 10K or whether you're placing it outside a 10K, there's a certain level of veracity that the information needs to connote. So what we are seeing more and more, that it used to be almost kind of a disconnected cottage industry. Companies used to have their director of sustainability or the head of HR. They were providing certain information, including for rating agencies, for annual surveys, and life was good. But now with the greater demand, with the greater investor attentions, what we are seeing is much greater introduction of controls, processes, policies, how a data measure is calculated, how it is communicated, regardless of where the item is communicated. We're seeing more and more companies are providing sustainability report or corporate responsibility reports and the like, and we're seeing more and more measures and goals and metrics that are penetrating into those reports, but it goes beyond the report. It finds itself in a shareholder letter. It finds itself in a commitment that companies made externally. It's showing itself in certain areas where companies make a difference, whether it's commitment to being net zero by a particular year or others. So it's important to think about how it's managed, how it's controlled. And, I think, Don, I know how much you've shared with the group, but we as EY, we not only thinking about it as the right thing for our clients, we're thinking about it as the right thing for ourselves. We are living and breathing it within our own organization, our measures and metrics and how we are measured, how we are managed, how we are driving our business is largely driven to that, including our external reporting. So needless to say, we are fully a believer and an adapters and a core force in helping our clients moving in that direction as well. So let's move on to the next slide, and I'm going to take a short break. And Dianora, I'm going to yield to you to take us through the next section.
Sure. Thanks, Neri. So I think that was a good laying the foundation on what LTV is. And as you can tell, there are just so many forces at play here. So in this section, we just kind of want to talk through some of the bigger macro forces that are at play that are driving the stakeholder capitalism and the focus on LTV. So just, I guess, a few highlights on this slide. The first one, institutional investors are voting against companies they perceive to lack a focus on the long term. And we saw this so much in 2020 and now in 2021. It was sort of a shock in I think it was July of 2020, State Street it was BlackRock. They put out a report and they highlighted 250 companies and they put them on a watch list. And they said that these companies are making insufficient progress to integrate climate risks into their financial disclosures and their business approaches. And of that group of 250 companies, they actually spoke about how they took action against management, whether it was by voting against voting against management or whatever have you. They took action against 50 of those companies, and then the remaining 200 companies, they just kept them on this, what they call the watch list. So they've been very focused and vocal about how they're going to hold companies and management accountable toward these long-term value ESG priorities. So that's BlackRock. State Street, the same thing. If you look at their most recent 2021 letter to CEOs, they talked about how it was almost two main priorities. They talked about climate change and what companies should be disclosing there, and also D&I and what they're expecting companies to disclose in that area over the next 3 years. And again, they caveat everything with the fact that they can and will vote against management if they're not taking sufficient action. So that definitely captures the attention of public companies, right? You want your institutional investors to be happy with the way that management is running the company, and this seems to be a priority to them. So management is really shifting gears and focusing on how they can communicate this externally. Another big trend is just how consumers are redefining the market demand through their purpose-driven purchasing. And you see it more and more now where companies are really making a clearer connection between what they do and their purpose. And I'm that way. So I'll spend the extra $8 on a cleaning product that's made in a more sustainable way, or $20 on extra dollars on a pair of sneakers if they're giving back to their communities. And because I want to support companies that stand for what I believe in and that are doing good for the world. And I'm just one consumer. This is sort of a growing trend. And so companies then have to think about how consumers are spending their money this way and are starting to support more sustainable organizations. And the last thing I'll cover here is just climate change, social changes, and equality become mainstream. I think it goes without saying, these aren't nice things to address if you have the time and resources anymore. They become a business imperative. And I look at the Biden administration, I think that's just such a great example of the tone at the top. This is, one of the top priorities of the Biden administration. So it's just almost an expectation that companies should be doing these things. So I guess just more, macro trends here. We talked a little bit about State Street and BlackRock and all that they're doing in this space. But there are just so many things going on. You couldn't cover it on this entire meeting, but maybe the World Economic Forum, the IBC, which is a group of 180 plus CEOs, they got together in 2018 and they ultimately published a report earlier this year that included metrics that they expect companies to disclose that relate to climate change, social issues, governance issues. So they put out these metrics, and these aren't new metrics. I think that's something to take note of. These are metrics that they pulled from the SASB and other reporting groups. And they said, okay, here's what we are maybe prioritizing. 61 of all of the companies said that they were going to start disclosing these metrics, which, it's a big movement. More and more companies are getting on board. And maybe I'll just focus on the SEC here. Neri alluded to it, but there's a lot of regulatory, in the past six months, let's call it, the SEC, they mandated human capital disclosures. So now, any 10K that's come out since November of 2020, they've had to include in their item 1 any metric or objective that pertains to their human capital, So it's been interesting to see what companies have been disclosing in that space. And the majority of them are talking about things like D&I and, how they're training and investing in their employees. And so this is sort of the first of its kind where companies are including that in their SEC filing. I think that's all I'll cover on this page. I guess maybe a little bit more though on the SEC. I think it was last week they appointed a senior advisor to climate and ESG. So again, like the SEC is really moving in this direction, and they made a few announcements that we'll get to on another slide. But I think what we're just trying to get to, and this is maybe the last slide about it, is just there's just so much going on in this space, and there's so many different things that are working together to sort of elevate and push forward this stakeholder capitalism and long-term value. So I guess there are really 3 themes on this slide. The first one being that investors are prioritizing this long-term focused. And if you look at any surveys that have been conducted in the past year on ESG and long-term value, it's coming up in the first, second, and third place on their different priorities. In this one survey we have here, we've got the environmental issues that were ranked very highly, and also board diversity, 2 main ESG issues. There's more money going to ESG directed funds. Investors are incorporating how a company is reporting on ESG metrics into their evaluation and understanding of a company. So, the investors were really getting to there is they're looking a lot more at it. And then maybe the right-hand side of this page is also answering a very important question that we hear a lot of the time is, is there a financial incentive for me to do this? Okay, great, I'm going to spend all this money and I'm going to do these things, but does it pay off? I think some people, they still can't get past the bottom line. Am I making a financial return by doing this? And it's so interesting because there have been a lot of studies done in the past few years that, they rank the most socially responsible companies, and they map out how well they've performed compared to maybe peers that aren't as socially responsible. And time again, they outperform. So I guess if you pause in the end of 2019, these studies were really growing and growing, and you were seeing it more often that they did outperform. And then we all sort of wondered what was going to happen during COVID. Were companies going to still be able to prioritize these things? Are they going to have to preserve capital and therefore not be able to focus on this stuff? And so anyway, a few months in, the study started again, and they looked at companies that communicated how they cared for their employees and their communities during COVID, and they were able to map out. I think State Street was one of the organizations that did a study on this, but it showed that these companies that were socially responsible during COVID also outperformed their peers. So I think the story on the right-hand side of the slide is just, there is a correlation between your financial performance and how much you prioritize and communicate ESG and long-term value. And that remains true even in turbulent times like COVID. So that's kind of it on the evolving landscape. I know that there's definitely a lot going, a lot of market forces driving this. I'll maybe pause. I know this is a conversation. If there are any questions, definitely feel free to cut it and ask them. Otherwise, maybe I'll keep going and just talk about the ever-evolving landscape. And we included this slide. And
Nora, there was a question in the chat that was directed at me, but can I throw it at you?
Sure.
And just to make it conversational. So let me just read it to you, and then maybe you can we'll get your reaction. From what I've seen in the past is that corporations set guidelines, but they don't follow them from an internal perspective, i.e. their management, especially their senior management, does not lead by example. Thus, many outsiders consider the actions purely PR. What has been your experience? Any comments?
Well, yeah, Neri, I'd love to hear your thoughts on it as well. But I mean, at EY, we have definitely prioritized this. And as an employee there, I see all that we're doing, just climate related, employee related, caring for the employees. So I'm in a nice position where I feel that my company is saying what they want to be doing, and they're doing it. But I do think that for those organizations that are maybe talking about it, but not actually acting out on it, there is going to be greater accountability in how, they're assessed. It's interesting. I've read some reports where investors will actually look at Glassdoor ratings to see how well our employees feel about their company, which, it seems like a very interesting and maybe unreliable data point, but they are looking at that. So if you do have 80% of your workforce that feels that way, it's going to show up somewhere, whether it is in, their Glassdoor ratings, or if they do start to disclose, a lot of companies do those engagement surveys and they, ask you to rank management and those sorts of things. We're seeing a lot of the results from those surveys included in the human capital disclosures in a 10K. So if that becomes a trend and maybe an expectation by industry, if a company is not disclosing that, then it just might make you scratch your head and wonder if management is really acting by what they're saying. What do you think, Gary?
I would add to it, and I'm just going to take first a layman approach, right? The first dimension is we all must agree that it's relevant and it's important. Because if it's not relevant, it's important, no one cares. And that becomes, either a chapter in an HR manual or a flavor of the day. So and again, it's not everything and anything. Companies cannot do everything and anything, right? And even if you do you want to be net zero by 2025, 2030, or 2050? Do you want to have certain education objectives for your employees? How do you want to fund it? So there's always trade-off. If you want to close a factory and you suggest I'll never close a factory because employees going to just lose jobs, you're losing the nexus between business decisions and how you make it. So it's not it's not an or, it's an and. I do think the important thing here is first, it's got to be important. The second thing, you got to be real about it. And thirdly, if market has greater visibility to it, whether it's through your goals, either because of the question they ask, either because, as you know, the markets are looking at data for various directions. It's not only human resource data from Glassdoor, it's various other things that, either hedge funds or others are looking at. Information is available also outside disclosure. First, they're going to hold you honest if it's appropriate, right? If if you simply, speak loosely, you misguide the market on your measures, somebody's going to call you a bluff for whatever reason because they want to get some level of financial incentives, or they're an activist or something else. That's number one. The second thing that I think could be important is, if it's important to the market, they're going to start looking at the strategy. Stated differently, let's say that I'm the CEO of a company and I'm suggesting this year and next year I'm going to invest in R&D, and I'm going to invest heavily in R&D, and I'm going to invest in the following areas. And I communicate to the analysts, and let's presuppose for just 1 second that it's important. And it simply was lip service. I didn't do what I meant to do. It wasn't serious, or I didn't hire the right research and development managers, and my ROI is horrendous. What would analysts do when they're on an analyst call? What would investors do when they're going to look at management and say, management is not credible. Management is not doing what it's supposed to be doing. Management is totally window dressing. And this applies to a variety of areas. All I'm suggesting that what we are seeing here, and I'm not suggesting it's everything, but in some areas and some directions, it becomes much more mainstream than it has ever been. And the trajectory that I'm suggesting will play into it. The other important thing that I would raise, it becomes actually a really important, let's say it's not an issue that none of us even believe it. It's not an issue of belief. It's simply an issue of cost to play. You're seeing more and more lenders that are looking at green bonds. You're seeing more and more bonds with some incentives or modifier. You're seeing more and more government grants that are directed in the area. It's not implausible that the Biden administration will come in and suggest that if you need to be a government contractor, you have to make certain commitments to energy efficiencies by year X or Y and Z and show us a credible plan if you want to provide an RFP to be a significant government contractor. You can be in an index or outside an index, it's going to affect your cost of capital. So, at some point, those are pronounced business decisions. And if management doesn't manage the business in an appropriate fashion, one would think that somebody's going to hold their feet to the fire, whether it's going to be the market, whether it's going to be their board, or whether it's going to be anyone else. So it's been a long answer, but I would just suggest that if management truly think about it as the flavor of the day, if management is simply going to start putting goals that they are not going to follow, I think their employees going to vote with their feet. Their customers going to vote with their feet. The analyst is going to call them on that. The board may not remunerate them for that because their measures are going to start and are more than ever including those measures. And if you just think about it all together, theoretically speaking, it's going to get the system to play out in a more concrete way and in a more thoughtful way. While again, I'm getting the skepticism, and I'm fully subscribed to it because I lived in the same environment. I'm just suggesting that the environment that we are going into is different than the environment that we exited in the last 2 decades. So don't get me wrong, whoever asked this question, I'm not diminishing the question. I lived through the same environment. I fully respect it, and I'm seeing the same thing. Back to you, Dianora.
Okay, yeah, thanks, Neri. And thank you for the question. So again, this is just in February alone. So I feel like every week there was just some big change and some big announcement. So we just highlighted a few things on the slide, and you probably had the chance to look over them now. I think there are sort of two big forces at play here on this one. Is just what is going on with the IFRS Foundation and their plan to set up a board similar to their accounting standards board, but focused on sustainability. And they're just moving quickly. I guess that's the takeaway there. They're moving quickly, and we expect to see more from there. Of course, that would govern European companies, and others, but just something to keep an eye on. And closer to home, we just have what has come up recently at the SEC, where the acting chair directed corporate to look at guidance that was issued in 2010 around climate change matters. And it's still TBD on what this will mean and how CorpFin will engage companies, whether they have roundtables to talk about this stuff, or if they're going to issue comment letters and say, we expect to see more in your risk factors section or in your MD&A on climate change. So I think everybody's still sort of on the edge of their seat to see what's going to really come out of the SEC on this. And I know that we have some private companies here, so definitely wanted to touch on this. I know that what the SEC does is not super close to home and maybe not the top priority for what you think about, but there are implications for, you know, this long-term value and this ESG focus for private companies as well. And you know, it comes in the form of your talent attraction. Again, you know, a lot of people want to work for companies now that are aligned with their own purpose and want to have the sense that they're contributing to the well-being of society, and they don't want to work for companies where they don't see them as doing good for the world. So there's the element of having the best talent to work for you. There's also then your customer loyalty, and we spoke about that before, and just, you know, are your customers going to be loyal to you or the store next door because they are doing more for the communities. I think an interesting one is the supply chain implication. So a lot of private companies might be supplying things to public companies, and public companies may publicly disclose, you know, guidelines or requirements that they hold their suppliers to. So that then could trickle down to you and have an implication as the supply chain provider to that company, is just, you know, how are they mandating and changing the game for then your private company and how you operate. So it's got implications for both public and private companies.
And more PE companies and the like are introducing certain mandates of how they think about their portfolio companies and certain behavior. So we're seeing it within our dialogue with PE companies as well. If you look at NASDAQ's recent proposal on the board diversity within NASDAQ, so that's going to be mandated, that is now in front of the SEC, is yet another. So you're seeing a lot of things that are just coming down, and they kind of, you know, there's a ripple effect that is not necessarily affecting solely those companies that are in public markets.
We have a question from the audience in the chat I just wanted to quickly bring up. Peter asked, have you found that the market is more accepting of short-term decreased ROI for the ESG measures or investments?
It's an excellent question, Peter. Again, the question is either or. I think the issue is how companies doing about translating performance to future outcome. So I need to suggest that my short-term performance was virtually impacted because I've done some things versus the goal and link it to it. So if there's exceptional investments, and I can tell you the market is generally not that patient. As much as many are just doing it. A very interesting example coming actually from Danone out in Europe. For those of you that are following the markets, you've seen that their prospects have not been great. There's some discussion about CEOs and activists are there with the board replacing the CEO. Danone has been a poster child for many actions around sustainability, and they were leading in that area. So it's not the or. You cannot diminish appropriate performance. I think there's an element here, and clearly the market is more acceptance because the market is putting more money there. The market is more accepting because the market is more accepting of but the strategy has to be clear. The strategy has to clearly look at a trade-off. The strategy has to be credible, and the market has to buy into the story. The other thing that you're seeing is the evolution of many, many other companies that are actually, and this is totally different than what I'm describing now, that looking at a different mandate, whether it's renewable energy, whether it's, and those plays, this is where capital is moving and migrating to. So it's not that I suggest that the equity markets are suddenly moving to such a fundamental analysis, and they're looking at it. We all know how the equity markets behave. So I would not sit here and suggest, Peter, that there's one-on-one correlation, but I do suggest that there's much and large basis points influence in that decision in the market, and it's only increasing. And the other, just how one can measure whether, BlackRock, that happened to be its largest shareholders, vote with or against the company in its response to an activist, right? So it's very, very, very difficult to assert one versus the other. But when you start thinking about it, or BlackRock increases its concentration in the stock because of something, or the inverse, decreases. But if I start thinking about all those trends, and the other thing that I think ties to the earlier question, in the past, even BlackRock and State Street have not had a credible approach to how they connect their talk with the walk. They've asserted that on one side of the house, but their investment side not always have done that. What they're doing now more than ever, they're actually putting the money where their mouth is much more than ever. So again, what I'm trying to suggest here, that we are in a trajectory. We are seeing more and more on that. And I think we will see more and more, but it's not stratified to a level that there is an immediate recognition. There's clearly still a healthy amount of impatience in the market that still remains.
Yeah, and one other thing too, I don't know if you saw the news last week or the week before, Walmart made the announcements that they were going to increase minimum wage for their employees to, was it $16 or $19 an hour? So I think we're seeing it live, and we'll see, you know, that of course will have an impact on their bottom line, but you know, we can do the math on that, but how will it affect customers' perception of Walmart? Yet to be seen, and something that will be interesting to stay tuned to. I know we're getting close on time, so I think this next section will maybe go through it a little quickly, but just wanted to talk about EY's long-term value framework. You know, and Neri went through the alphabet soup and all of the options that companies have out there as far as, you know, frameworks, rating agencies, different standard setters. You know, how do you approach this? EY, we have a framework where we essentially look at 4 value drivers. They were on the first slide, but you have your financial pillar, consumer pillar, human pillar, and societal pillar. And it's a great first step to take a look and look at what your company does or what your organization does through the lens of these pillars. It's a framework. So, you know, you might end up with different pillars. If you're a healthcare company, you might not have a consumer pillar, you might have a patient pillar, but having a framework there by which to look at this and to organize your approach is super important. And I'll go to this slide. I love this slide because it really drives, I think, a point home, especially to a group of finance professionals. This is the bridge slide. So you're taking all these non-financial, you know, topics. So you have your consumer value, human value, societal value, all these soft topics. How do they actually then translate to financial enterprise value? So, you know, take, for example, like under human value, you know, how well you take care of your employees, whether you invest in them via training, you know, tone at the top, all of these things will contribute to your bottom line via lower labor costs, because you might have less turnover, you'll have more engaged employees, you'll have happier employees, and that does have a financial implication that affects your bottom line. Same thing with your consumer value. The more you listen to what your consumers want and you innovate and you gain their trust, the more you focus on these things, this is going to increase customer affinity. And that, again, is going to drive financial value for your organization. So I think this just paints the picture well of, you know, yes, these are softer topics, but they translate directly into something that creates financial value, and something that I know everybody on this call knows very well. So I think we'll end on the topic of the role of finance in LTV, the finance function. I'll turn that over to you, Neri.
Thank you, Gino. And I would like to just underscore one point that you made about the framework. And framework, it's not one size fits all. Framework is a framework. So the answer is doing nothing is not the right answer, and being in 100% may or may not be the right answer. The question is, where are you today? Where do you want to be? The framework could be as simple as looking at what Dianora has just suggested, breaking the value drivers to its element, thinking about what is important to whom, what's important to your employees, your rating agencies, your capital providers, and others. You can create a heat map. You can do it on the back of an envelope. You can use dashboards, you can use metrics, you can use measures, depending on the maturity of the enterprise. So what we're suggesting here is not that there is one, you know, Uber computer or an SAP system that you can take to an organization and bring it all together. It's the issue is how you bring this framework that Dianora spoke to, build it into your existing rhythm. think about it, making sure that you align your organization against its objectives in the most appropriate way. Start thinking about it, pave the way given the kind underpinning, and allowing yourself to make a decision. So this is an organization decision enablement decision. It's a risk. You can make a risk decision, you can make managerial decision, you can make strategic decisions, or all of the, and regulatory decision, because certain things I have to do because I don't have a choice, right? You know, if whether I think my human capital disclosure, it's important or not, if it's compulsory because of the SEC, I'm going to have to put it there. So there's certain things that simply are table stakes, and there's some other things that you want to do a little bit more than regulatory expectations will connote. So I alluded to the role of finance function, and I think this is an important one. It used to be that finance professionals completed 10K or an annual report or financial statements, filed them, sent them to Edgar, and they were linked to a website. Now it's totally different. And by the way, people were consuming information that way because that's how they got information. Given what we discussed earlier, the means and availability of information and actionable information for investors, creditors, regulators, and other stakeholders run the gamut. The other thing that we're doing with companies is making sure it's all connected. And when we go into the connectivity issues, we're also talking a lot of time about efficiency issues. It's amazing how inefficient the processes are within companies. It's amazing how much redundancy there is. It's amazing how many times things are being said in the same way, in different times, or in different verbiage, or in an inconsistent way. It's interesting how much time is spent when one function is not connected to the other. So this slide is a very interesting one because it alluded to one is how you really tell the story, making sure that your company story is not kind of a book whose chapter or verses are written by different authors. It hangs well together. It's also important to recognize that it all represents yourself appropriately, it's managed appropriately, it's efficient, it's effective, it meets your own requirements, it meets regulatory requirements, and it creates a feedback loop. Because the issue is here not to only to report, is to appropriately report, to appropriately manage. Because if I'm only reporting, this is great, but if I didn't manage properly to the reporting, it becomes an exercise in bookkeeping, not to offend the bookkeepers on the call. So that's an important notion to consider as you're thinking about the process to integrate the story. And it's manufacturing theory. If the conveyor belt is not run appropriately, the product is not manufactured efficiently. So for those of you that are in manufacturing, you can simply superimpose it on production theory. Let's move on to the next slide. And by the way, this is what we do with our clients. This is where this is the holy grail of our work with clients. This is where we speak with controllers and finance executives and CFO, and I can tell you, this is what I alluded to earlier. 10 years ago, it was a cottage industry. Some of them were interested, say, good idea, I'll do what I need to do, and then, hey, Neri, let's come back next time. They were really polite, they were really nice, they had a discussion, but it was not significant, right? So, and it was not, and again, environments change. In today's environment, it becomes a much greater exercise. And what Nora mentioned earlier in the IFRS Foundation, the IFRS Foundation could be an organization that will harmonize some of the disclosures around non-financial disclosures. So we are seeing more and more traditional accounting thinking. The Big Four and accounting standards are starting to think about what are the virtues they're going to be. More assurance is required, more data veracity is required, controls, and then process, even efficiencies, right? If I need to have a repetitive process to procure data in a reasonable way, quarter over quarter, month over month, year over year, because people need it, it requires certain skill sets that are now becoming part of a core finance function or a greater necessity for finance professionals to engage in. So we are seeing much more of that. And if we running CFO forums and the controller forum, similar to that one, and 5 years ago, they didn't want to hear about the topic. Now the steering committee are actually asking, if not yearning, to bring the discussion. They talk to each other about how they do it, and they collaborating on demands, software, tools, and enablers. Let's move to the next slide, please, Lenora. taking action. So this is the words of our own CEO. But again, it's not necessarily the words of our own CEOs. I think his words and sentiments here are echoed by many forums that he's participants in, including the World Economic Forum, including the Business Roundtable, who has spoken about the role of corporation in the U.S. and many others. So I think the greater sentiment that's important here is moving just beyond metrics. It's not an exercise in metrics and reporting. It's an exercise of management and enshrining it into a corporate repetition, DNA, and posture. Let's move on to the next slide. This is more tactical, right? How one should think about embedding LTV with your own DNA, right? And we spoke about it, but it's just this is just a vertical depiction of how one is to go about it, setting the strategy, measuring and report, and then embedding and accelerating it. So if you look at the right side of the slide and you go to those elements, you can choose how to do it any way you want to do it and in any dimension you want to do it. But those are the type of areas that we work with companies to start revisiting it. And if you do it in a systematic way and a thoughtful way and long-term way, it's not just something that I want to do and I want to achieve immediately. It's a journey. It's not one and done. You will achieve the right objective. And by the way, there's no right or wrong, and there's no single silver bullet that will apply to all. And by the way, companies starting to differentiate, right? It's not a convergence necessarily to a mean here. And we are seeing from the SEC principle-based disclosure for human capital, the companies are differentiating. So one could argue it may converge to a mean by industry over time, but what we are seeing now is a variety of practices and approaches. And companies are suggesting that some of it could be their edge to achieve certain alpha, regardless of, and under the presumption that the alpha would exist. And by the way, they're putting serious money behind it. It's not just that it's not just statements. Serious corporate money is placed behind those commitments. Let's move to the next slide. Key takeaway. Do you want to recap it for us?
Sure. I know we covered a lot on this conversation, so I may maybe even recap before we get to these takeaways. I hope everybody really understands what long-term value is and what we mean by long-term value, and the fact that ESG is certainly part of that conversation and maybe a subset of it. There are a lot of forces at play propelling long-term value and propelling its prominence in the market, capturing the attention of regulators, CEOs, and investors. Board members, it's just really a top priority across the board. A lot of market forces at play. EY, we have our long-term value framework, and it helps to sort of organize everything that a company is doing under a framework. And here are some questions that you as leadership at your company should be asking, and whether it's raising the conversation in the boardroom or just among your team. Thinking through how are we currently, are we tying our purpose and strategy? Are we using this to our competitive advantage? And just sort of going through these things. And if the answer to any of these are no, there's definitely an opportunity to say, okay, what can we do to enhance this? And I think on this previous slide that Neri was on, there are a host of things that you can do. So lots of opportunity, a lot going on in this space. And it's just a fun topic. Probably more interesting than lease accounting, which is maybe what you were talking about this time last year. So reach out, I guess, if you have any questions or comments. And thank you again for having us here to speak about this.
Well, thank you so much to all of you for joining us today. I know we'll be following up with all the attendees to share the recording and share some more information on what was presented today. And I know that the EY team is always open to connecting over email if there's more in-depth conversations to be had. Neri, Don, Maureen, any final remarks here?
I guess I'll leave you guys with this. I think, a lot of the dialogue focuses on public companies, which are driving this effort. But I think our private companies out there, are going to follow very closely. And Neri and Theonora talked a lot about sort of the impact on access to capital and things like that. But I think if you're a private company saying this doesn't really apply to me, I just challenge you to really give that some thought, because I think this is more of a movement in business in general. And we're happy to help answer questions and try to bring that to life for you. So I'll thank you all again for joining, and look forward to having you attend in the future.
Thank you, everyone. Jason asked a quick question. With quarterly earnings coming from public companies, how will this change going into the future? I would just suggest take a look at how much companies started to talk about stuff at the start of COVID in their quarterly calls. They had slides that were dedicated to here's how we're taking care of our employees, here's how we're taking care of our communities. So they started to embed this into their quarterly reports. And I don't know if they're going to take that out now post-COVID. It might just be something that stays in. So I just wanted to suggest that. Take a look at how companies started to talk about that during COVID. It was fantastic.
Awesome. Sounds good. All
Thanks.
right. Well,
Thanks
you
for
all
having us.
and have a great rest of your week. We'll talk soon. Bye, everyone.